This is the History Lessons Podcast with certified financial planning practitioner, Patrick Huey.
And welcome back to History Lessons for the Modern Investor. It's Friday. That means instead of history, we're talking about your future, your financial future. And this week we're talking about donor advised funds, often abbreviated DAF or simply DAFs. Now, these funds can be a game changer for your charitable giving strategy, assuming that you have one, but it's crucial to know when and how to use them effectively. So in this short video, I'll walk you through the key points on when to use a donor advised fund to aid you in your charitable giving. What is a donor advised fund? Well, before we dive in when to use them, let's quickly recap what they are. A donor advised fund is essentially a charitable savings or investment account that allows you, the donor, to contribute assets and then recommend grants to whatever 503c charities you choose. You contribute assets to the fund, receive an immediate tax deduction, and then recommend grants to your favorite charities over time. What are the advantages of a donor advised fund? Well, let's take a look. Number one, the tax benefits. Donor advised funds offer immediate tax deductions when you contribute assets, which can be especially advantageous during high income years. Think offsetting capital gains or some type of lump sum distribution that you receive in a given year. If you're looking for a way to offset taxes and you're charitably inclined in any way, shape, or form, start thinking about a donor advised fund. Two, simplified giving. Managing donations becomes more convenient since you can make recommendations from one fund rather than dealing with multiple charity transactions. And third, strategic giving. Donor advised funds provide flexibility in choosing when and how much to donate, allowing you to strategize your giving for maximum impact. Here's another little tidbit on strategy. If you don't have a charitable giving strategy, it's a good time to get one. Why? Because a strategy allows you not only the ability to give for maximum impact, but the ability to say no. It's much easier to say no to a charity in a nice way when you have a strategy behind it. You simply say, I'm sorry, I'd love to give you X, Y, and Z funds, but you're not part of my strategic giving strategy at this time. It's just a nicer way to do things. When do you use a donor advised fund? Well, you should consider it for your charitable giving in a couple of scenarios. I'll run through those here. First, a windfall or a bonus. If you receive a financial windfall, year-end bonus, you can use a donor advised fund to maximize your tax deduction while planning your charitable contributions. Obviously, again, this assumes some type of charitable intent. Second, volatile income. Donor advised funds are great for individuals or families with irregular income, like entrepreneurs, freelancers, or somebody who's a lot of their income is tied to like a sales bonus or something like that. They can make contributions during prosperous times and distribute funds to charities as needed in the future. Third, long-term giving strategy. If you have a long-term charitable giving strategy or intend to create a family legacy of giving, a donor advised fund can help you execute that plan efficiently. Indeed, for families who have endowments, the donor advised fund may actually be a lower cost, easier managed solution than the full-blown family endowment. Now, if you're going to go that route, make sure you're obeying state and federal laws on how to convert from an endowment into a donor advised fund, and be sure that you're going to be getting the amount of service that you need. But if cost is a factor, and let's be honest, when isn't it? Take a look at a donor advised fund. Okay, before we wrap up for this week, let's take a look at the flow chart that I brought up here. And if you are not watching this in a video format, please feel free to go to the show notes and download the flowchart. Should I use a donor-advised fund when giving to public charities? We're going to start over on the left side. And on the left side, we're going to ask the question, do you make substantial charitable gifts on an annual basis? Guess what? Like we said, if you are charitably inclined, this can be a great vehicle for you. But that doesn't necessarily mean you have to be charitably inclined now. It could be that you want to make substantial charitable gifts at your death. That's fine. Donor-advised fund could be used for such a purpose. However, anytime in between now and your demise, if you're going to be charitably inclined, a donor-advised fund may be for you. Do you typically claim the standard deduction? If you do, then the donor-advised fund may help you with your taxes. It may help you be able to claim itemized deductions. When you bunch your charitable contributions for future years into one, now you're creating a higher amount of deductions that can propel you beyond the standard deduction. So consider bunching your charitable contributions. Do you want to retain control over the timing of the ultimate distribution to the charities? Well, sure you do. Otherwise, we probably wouldn't have gotten this far. If you are just enjoying making out checks, then you probably don't really need this type of strategy. But what we're talking about here is I want to put money away, I want to get my tax deduction now, and then I want to control the timing in the future. Now, the donor-advised fund is not the only way to do that. So be sure to pay attention to this box. Do you want to make a gift that benefits both charitable and non-charitable beneficiaries? If that's the case, if you're trying to benefit both you, your family, and a charity, that's what's called a split gift. Okay, so a split interest gift strategy. We'll get into those in later videos, but we're talking about some type of charitable lead or charitable remainder trust where we're splitting who gets what in that case. With a donor-advised fund, the only split is between what charities you choose. It's all going to charity eventually. Once you've decided that you're probably leaning in that donor-advised fund direction, consider if you have highly appreciated securities. Highly appreciated securities are fantastic ways to start a donor-advised fund. Why? You take out that potential taxation from your overall portfolio. You create the contribution that you were going to contribute anyway. And now you've saved yourself on taxes now when you contribute the funds and you get your above the standard deduction. But you also save taxes in the future because you're not going to realize them when you sell these highly appreciated assets. Okay, we'll wrap there. If you have any questions on any of the material presented here, feel free to drop a line in the chat or the comments, or send me an email. My email is provided in the show notes. In conclusion, donor-advised funds can be a powerful tool to enhance your charitable giving. Use them strategically during the right moments in your financial journey. You can maximize your impact while enjoying amazing tax benefits. Now, if you found this video helpful, please give it a thumbs up and subscribe for more insightful content on financial planning and philanthropy. And remember, the more you give, the more you can make a positive change in the world. Thanks, and have a good weekend.
See you next week.